Hi, good day everyone, and welcome to another session of our video. And in this video we will definitely be looking at acquisition within the year. That is a situation whereby the parent company acquires the subsidiary company within the year, and what do we actually refers to as acquisition within the year in a group settings. We said a subsidiary is actually acquired within the year if the difference between the date of acquisition and the date of reporting is less than 12 calendar months. That is, we acquire this company and the period of acquisition is less than 12 calendar months. In such circumstances, we refer to such acquisition as acquisition within the year. Now, all the knowledge of basic group accounting, everything we've learned so far remain in place. But the major thing that we need to understand when we have acquisition within the year majorly deals with the way we account for our retained earnings. Because if I acquire a subsidiary within the year, say 6 months ago, it means that any profit or any loss generated by that company from 6 months ago will be what I will refer to as my post-acquisition profit. So which means the major differences with the basic knowledge of group accounting and when we are dealing with a question on acquisition within the year is the ability to prorate the profit for the year, to allocate it between pre-acquisition period and the post-acquisition period. So that is the major difference when we are dealing with consolidated statement of financial position. And we will be looking at two solid questions today, starting with a bit simple question and we look at a more complex scenario. Looking at this question here, we are told here that a subsidiary was acquired 3 months ago and it had profit for the accounting period to be 400 million, and the retained earning at the end of the accounting period of $700 million required. Ascertain the retained earnings at the date of acquisition. This is very easy. Like I said the major knowledge is how to prorate. Coming to my solution side here, you can see that we are told that the profit generated during the year in this question, we are given the profits to be 400 million for the year. If my profit for the year is 400 million, very easy and straight, from the beginning to the end, that is 400 million. But don't forget, we acquired this company 3 months ago, which means that from the beginning of the year, which is here, up to 9 months, this business is actually in the stage of pre-acquisition. That is, this business is not yet our subsidiary as at this date. We became the parent company 3 months ago, which means that any profit that will be taken as post-acquisition profit are actually profit from 3 months ago. And also it is possible that we have post-acquisition losses too. If there is any losses that will be allocated to us, they are losses that relate to 3 months ago since we acquired this company. And as such, if the profit for the year is 400 million and I acquired this company 3 months ago, so I can say that my post-acquisition profit is 3 out of 12 multiplied by 400 million for the year, and this will give us a total of $100 million. So I can come here and say that my post-acquisition profit is 100 million. Once I can do that, it is very easy and straight. Coming back to my question said something. My question says retained earnings at the end of the accounting period of 700 million. Don't forget, we are currently at the end of accounting period, which is our reporting date. If my reporting date is 700 and my post acquisition profit is 100 million, don't forget, it is the difference between date of reporting and date of acquisition that actually give us post acquisition. And in this question, I actually know my date of reporting as given in the question to be $700 million, and I calculated my post acquisition profit to be $100 million. Automatically, at the date of acquisition, I will be having 700 less 100 million, and I will have 600 million. Very easy and straight. So now that you have basic understanding of how acquisition within the year works, let us now look at a more detailed and examinable question. The question says, 6 months prior to year end, Romeo purchased 1,800 million shares in Juliet. Juliet has a profit for the year of 2,500 million. The acquisition was through a share for share exchange of 1 share in Romeo for every 6 in Juliet. Both companies have shares with a par value of $1 each. The market value of Romeo shares at acquisition was $3 and Juliet $2.5. In addition, Romeo made a cash payment of 4,000 million and we also paid 2,000 million in cash. 3 years after the date of acquisition, Romeo cost of capital is 10%. The cash consideration has been recorded, but Romeo has yet to record either the issue of shares or the deferred consideration. So actually, before I continue reading this question, let me do proper analysis of the first paragraph in this question. The question says that we actually purchased 1,800 of the equity share of Juliet. Now, Juliet is our subsidiary here, and though I can't confirm yet that Juliet is a subsidiary until I confirm that Romeo owns more than 50% of the equity share of the company. So we purchased 1,800 million shares. Now, if I purchase shares in the subsidiary company, I need to furnish some consideration. Most time I may buy those shares by paying by cash. But in this question, is it only by cash? Let us check. The question says the acquisition was through a share for share exchange. So one of the ways which we pay is through share exchange. And all the question says again, in addition, Romeo made a cash payment of $4,000. Aside from share for share exchange, there is also a cash payment, so which makes my consideration transfer to be 2. We have share for share exchange, we have cash payment. And now, moving forward, what do you see again? And the question also say, now Romeo will also pay $2,000 in cash, but we want to pay $2,000 in cash. Are we paying the money tomorrow? Are we paying it today? No. We said we are paying it in 3 years time. And don't forget, if you are paying a particular sum of money in a future period, we call it a deferred consideration. And like most of you do ask, that what is the difference between deferred consideration and contingent consideration? Contingent consideration just looks like deferred consideration, but contingent consideration are future consideration which the parent company will furnish to the subsidiary company if a particular event occur or not occur. But deferred consideration is a certainty. I am to pay this money in a future period, not based on a particular condition. So analyzing the first paragraph, we can see 3 things which we are going to work on. We have the share for share exchange, we have cash payment, and we also have the deferred consideration. So continuing with the question, let's assume that all the figures are correct. We then move to the additional information. Additional information 1 says Romeo has a policy of accounting for NCI at acquisition at fair value. For this purpose, Juliet's share price at that date can be deemed to be representative of the fair value of the share held by the NCI. Following an impairment review, the goodwill is impaired by 300 million. Now, analyzing this additional information, we said measuring NCI. NCI can be measured using 2 ways. We said we can measure NCI using the proportionate method or using the fair value approach. And to use the fair value approach, which is also called the full goodwill approach, I just need the total shares owned by NCI and I multiply it by the share price of the subsidiary. I multiply it by the share price of the subsidiary, and that will give me my fair value of NCI. And at times, the question will be generous enough to tell you that the fair value of NCI is a particular figure. So, for additional information 2, Juliet had established a line of products under the brand name Acola, acting on behalf of Romeo. A firm specialist had valued the brand at a value of $500 million with an estimated useful life of 10 years. As at the date of acquisition, the brand is not recognized in Juliet's statement of financial position. Now, if there is an asset that is not recognized, that is not currently recognized in the statement of financial position, or that is recognized in the statement of financial position at any price that is lesser than the fair value, what do? We have to adjust it by calculating our fair value adjustment, which you will see by the time we start the solution. The last one says, during the year, Juliet has also sold goods to Romeo for $20 million at a margin of 25%. All these goods remain unsold by Juliet at the year end, and there are no current account balance at the year end. Required, prepare the consolidated statement of financial position for Romeo. Now, let us start our solution. So I come to my solution here. The first thing is to determine group structure, and to determine group structure is very easy. We are told here 6 months prior to year end, Romeo purchased 1,800 shares in Juliet. Now I need to confirm what is the percentage holding of Romeo in Juliet. I have 1,800. Now, if I purchase 1,800 shares in another company, I want to know what is the total shares even available in such company. Coming down here, under my equity, now here I can see clearly that the ordinary share is $1 each, and under Juliet, the total shares under Juliet is 3 million. Now, $3 million here divided by $1 will give me 3,000. So coming here, 1,800 divided by 3,000 times 100% will give me 60%. Now I already know that the parent company owns 60%, but we acquired this company, don't forget, we acquired 6 months ago, and we said any company that we acquire and the difference between the date of reporting and the date of acquisition is less than 12 months, we refer to it as acquisition within the year. The fact that we acquired 6 months ago, we can confirm that. Now the next thing is to determine the net asset of subsidiary, and I will be showing this both at the date of reporting and at the date of acquisition. And don't forget, the difference between date of reporting and date of acquisition will definitely give me post acquisition. So coming back to my question, I will come down here under equity, and I can see clearly that my ordinary shares under Juliet is 3,000. Coming here, I put 3,000 here. And also, what is my retained earnings at the date of reporting here? My retained earnings at the date of reporting is also 3,500. Very easy and straight. Now, we are told something here. Coming to the beginning of the question says 6 months prior to year end, Romeo purchased 1,800 million shares in Juliet. And listen again, the question says Juliet has a profit for the year of 2,500. Now, if the profit for the year from the beginning of the year to the end of the year, which is 12-month period, is 2,500, I acquired this company 6 months ago. So my post-acquisition profit will be 6 divided by 12 times 2,500, since that is the profit during the year, and that is what gave me 1,250. Now 1,250 is my post-acquisition profit. Now if that is my post-acquisition profit, don't forget the difference between the date of reporting and post-acquisition is what will give me my date of acquisition. You can see, simple and straight, I can get that. Now don't forget, during the period when we were analyzing this question, we look at additional information 2, which talk about fair value adjustment. So let us go there and do our proper adjustment. So Juliet had established a line of product under the brand name Aquila, acting on behalf of Romeo, a firm specialist. Now, due to our valuation, we are told that the brand is not in the statement of financial position, and as such, we have to bring it in by adjusting for it under fair value adjustment. And don't forget, the last 2 videos where we talk about fair value adjustment, if you missed that, look for it. We said the adjustments will appear at the date of reporting and at the date of acquisition. Bringing in the 500 million, it will appear at the date of reporting and at the date of acquisition. But don't forget, in this case, we are told that this brand have a useful life of 10 years, which means that we have to calculate additional depreciation. Now, if there is a useful life of 10 years, very easy and straight. Now, I will come here to calculate my depreciation. In this case, it will be 500 divided by 10 years. So I will get $50 per year. But don't forget, we acquired this company 6 months ago. So any depreciation we want to calculate must be for a period of 6 months. So that is why 500 divided by 10 will give me for 1 year, multiplied by 6/12. And if you are finding it hard to understand here, in my previous video, I did proper analysis of how to do fair value adjustment. You can look into that again. So the depreciation for the year multiplied by the date, the distance between the date of reporting and acquisition, and in this case 6 months, 6/12. That is how we got 25. And your additional depreciation or your excess depreciation, any case it may be, it will appear at the date of reporting and also under post acquisition period. So in this case, I can tell myself that I am successfully done with working note 2. So my net asset at the date of reporting is 6975. At the date of acquisition is 5750, giving me my post acquisition to be 1,225. Now after that, I move to the next phase, which is the determination of goodwill. And how do I calculate my goodwill? Very easy and straight, which we need to start from fair value of consideration transferred by parents. And as read earlier, we can see that fair value of consideration transferred was actually analyzed in the first paragraph. And let us go. We said the acquisition was through a share for share exchange of 1 share in Romeo for every 6 in Juliet. Now, listen carefully. I purchased 1,800 shares in the subsidiary, and for every share acquired, for every 6 share acquired, I will be giving them 1 in the parent company. So which means that my share exchange is 1/6. That is my share exchange ratio. So my 1/6 times how many shares did I really acquire? I acquired 1,800 shares. So this is telling me invariably that I will be giving the subsidiary company, I will be giving them 300 shares to acquire 1,800 shares. Very easy and straight. So multiply by what? What is this 3 naira? It is the share price of the parent company. Whenever you are dealing with share exchange, we've done this in our previous video, but if you are joining us for the first time, let me tell you again, whenever you are calculating share exchange, you multiply by the share price of the parent company, and it is given to us in this case that Romeo shares at acquisition was $3. That gave me 900. Also coming here, in addition, Romeo made a cash payment of 4,000. No thinking is required. I will come here, cash 4,000. And also we are told that we will pay 2,000 in 3 years after the date of acquisition. What do we refer to that one? We call it deferred consideration. And I said it in my previous video, and I will be telling you again, and put it at the back of your mind. Whenever we have deferred consideration, very easy, 2 things comes to your mind. You discount the cost to present value, and at the end of every year you unwind. You discount the cost to present value, and at the end of the year you unwind the finance cost. So whenever you have deferred consideration, 2 things comes to your mind: discount to present value, and at the end of the year unwind to reflect the finance cost. So in this case, what do I have? So I have 2,000 multiplied by, now we are given 10% as the cost of capital. You will be given the cost of capital in examination condition, and the cost of capital is 10%. So that is 1 plus 10%. That will give me 1.1 raised to power minus 3, giving me 1503. And adding all the consideration transferred by parents will give me 6403. So very easy. Add your non-controlling interest. Now, additional information 1 in the question told us how to account for our non-controlling interest. We are told to account for non-controlling interest using the fair value approach. And now, like I said, how do you do that? If you are given the share price of the subsidiary company, even if the question is silent, invariably they are telling you to use the fair value approach. And how do I do that? I need to know the total number of shares that is owned by the subsidiary, by the non-controlling interest. Now, the total shares we have is 3,000 in the subsidiary. But for that 3,000, the subsidiary have 3,000 shares in total, and NCI own 40% of those shares. So 40% of 3,000 will give us the total shares by the NCI. Now, what is the share price of the subsidiary company? The share price of the subsidiary company is 2.5 as given in the question. So giving me my total non-controlling interest to be 3,000. Adding it together give me 9403. Don't forget, after we get this, we normally less net asset of subsidiary at the date of acquisition, which was gotten in working note 2. And in working note 2, we can see that at the date of acquisition, the net asset was 5750. So if I less my 5750, I will get my goodwill at the date of acquisition. Now, additional information 1 said something about impairment. Following an impairment review, the goodwill is impaired by 300 million. So coming here, impairment is 300, giving me my goodwill at reporting to be 3353. Now, looking at this impairment, don't forget, we said whenever we use the proportionate method to measure NCI and there is impairment, such impairment will be suffered by only the parent company. But if I measure my NCI using the fair value approach, any impairment in that question will be suffered by both the parent company and the non-controlling interest. So moving forward, we go to non-controlling interest, which is working note 4. And under working note 4, what are we going to have? As calculated in working note 3, my NCI is 3,000. Now, any profits we make in this business, NCI is entitled to 40%, right? So my post-acquisition profit will be 40% times 1225 as gotten in working note 2, which is my post-acquisition profit in working note 2. So we are going to get 490. After that, we less impairment. 40% times the impairment, which is 300, will give us 120. We less impairment. But before we move on, we need to look at additional information 3. Additional information 3 says, during the year, Juliet has sold goods to Romeo for 20 million. Who is Juliet? Who is Romeo? Juliet is the subsidiary company. And don't forget, unrealized profit, we do ask ourselves the question, who is the seller? In this case, subsidiary is the seller. Now, and don't forget, 2 people own the subsidiary company. And who own the subsidiary company? The parent owns 60% and the NCI owns 40%. So if there is any unrealized profit from any sales from such company, the parent will suffer 60%, while the NCI will suffer 40%. So in this case, let us calculate our unrealized profit in our working note 6. So to get my unrealized profit, that will be 20 million multiplied by 25%. So we have 5 million. So this 5 million, NCI will suffer 40% of that 5, giving us 2 million. So at the end of the day, my total non-controlling interest will be 3368. We then go to the next working note, which is working note 5, which is on retained earnings. In my retained earnings, I will go to my account. And in my account here, what is the retained earning of parent at the date of reporting? The retained earnings of parent at the date of reporting is given as 6,000. So my balance brought forward is 6,000. After that, any profit in this business, the parent will get 60% of such. So my post-acquisition profit is 60% times 1225, giving me 735. After that, impairment. Impairment is 300 times 60%, giving me 180. And unrealized profit is 60% times 5, giving me 3 million. Now, before ending that, don't forget, I told you something under deferred consideration. I said whenever you have deferred consideration, 2 things come to mind: discount to present value, and at the end of every year, unwind. So in this case, as calculated in workings note 3 for deferred consideration, we calculated it to be 1503. So unwinding cost now is 1503 times what is the cost of capital that we use to discount this thing is 10%. So we multiplied by 10% will have given me 150. But don't forget, we acquired this company just 6 months ago. So we are preparing our accounts today. This is just a 6-month period, not for 1 year. So I will only unwind for 6/12, which is 6 months, giving me my unwinding cost to be 75. So the deferred consideration to be consolidated is 1578. That is the amount we are going to consolidate. So the unwinding cost will be deducted from our retained earnings. So unwinding cost here is 75. So automatically, so adding everything together, wow, there is a calculation error here. Adding everything together will give us 6,477 in this case. So we are done with working note 5. Also, we are done with working note 6 and 7. So we go to working note 8. Now, we are told in this question here that the cash consideration has been recorded, but Romeo has yet to record either the issue of shares or the deferred consideration. We've accounted for deferred consideration to be accounted for as 1578. Also for my issue of shares. Now, how many shares did we exchange with the subsidiary company? We gave them 1 for every 6 shares, which means that we will be giving them 300 ordinary shares. So how do we account for this? I debit my ordinary shares with 300 times $1, which is the par value of that shares, giving me 300 million. But don't forget, the market value of our shares when we were computing this was actually $3. So this actually means that if my par value is $1, I have made a profit of $2 per share, which we refer to as share premium. So I will credit my share premium with 300 times 2, which is 600. So 600 will come under share premium, while 300 will come under ordinary shares. So that is our workings for this question. So let us now see how our consolidated statement of financial position will look like. So we start. Tangible here, we have 10,000 and 5,000. Adding it together, we have 15,000. Don't forget, as calculated in workings note 2 under fair value adjustment, there was a brand of 500 and additional depreciation of 25, which give me 475. Goodwill as calculated in working note 3 gave me 3353, giving me my total non-current assets to be 18828. Now my current asset here is 3,000 and 4,000. Coming here, I put it here. Don't forget, as calculated in working note 6, any unrealized profits will be deducted from your inventory. But because in this case all current assets are combined, I remove it from current asset. Don't forget, giving me 6995, and my total asset will be 25823. We can then move to equity. Like I do say in every of my video, when you are accounting for equity, you don't add the equity of the subsidiary company. So in this case, I come here under my equity, ordinary shares is 5,000. Coming here, this is 5,000. Don't forget that the bond we gave to the owner of subsidiary was not accounted for, and as such, in our calculation in workings note 8, we said we credit our ordinary shares with 300, giving me 5,300 here, and my retained earnings in line with note 5 is 6477, and my share premium as calculated in note 8 also, we calculated it to be 600, giving me 12,377. And I need to add my non-controlling interest as calculated in workings note 4 with 3368. So my total equity is 15,745. We can then go to non-current liability. My non-current liability as given here is 4,000 and 2,000. Coming here, 4,000 and 2,000. Don't forget, deferred consideration, we are to make this payment in 3 years time, and as such it is a non-current liability. As calculated in workings note 7, we calculated our deferred consideration as 1578, which gives us 7578. So I can then move to current liabilities, which is 2500 here. So 2500 give me 2500. Automatically my total liability will give me 10,078, and my total equity and liability will be 25,823. And that marks the end of this wonderful question. Please don't forget to subscribe to my YouTube channel for more amazing video like this. See you next week.